Hey everybody, this is Coach D here with TackleTrading.com, and in this video, we're going to break down the breakout. And we're going to approach this from a swing trader's perspective. And what I have here is I've identified a chart setup on CarMax, ticker symbol KMX, that is poised for a breakout. Now, I got this stock set up off of our weekly stock report. We put out a stock report and an options report every week for the swing traders. And this particular candidate, we identified and posted this on Sunday. Well, here it is Tuesday, and I'm watching and ready for a breakout. And I believe the market's going to maintain a bullish bias. It may or may not. And we have a nice technical condition. So we're going to start out by talking about the technical conditions and criteria that we want to look for a good breakout setup. And then we're going to talk about some of the potential pros and cons of the trade. And then we're going to talk about how you can use the right order types and position size to help you control your risk and identify and to set up a high probability profit target for you where you have a really nice reward to risk ratio. And even though we can't control the outcome of the stock, whether it actually breaks out and follows through and runs up like we believe it will. But what we can control is our outcome. And so I'm going to start you out here with this CarMax, KMX ticker symbol setup. And what I see here on this chart is a breakout pattern of an all-time high. So let me grab my little drawing tool here and just identify that for you. Where in the last couple of months, really since that February-March meltdown, and the market establishing that low, it's run right back up with some strength and vigor, right back up into this all-time high out near 100 ballpark, out to maybe that 103 ballpark. And I'm just going to switch this over to a weekly time frame real quick so that you can see that this is really a nice breakout. And this is kind of an interesting thought, particularly to new traders and investors. How many of you before now have ever said to yourself, you know what? I want to find a stock that's trading at the most expensive price it's ever traded at, and I want to buy it. And that's really essentially what we're doing here. We're waiting for this stock to break that $100 barrier and really establish a new high price. Now, back before the meltdown, it poked its head up to 103 and then it got smacked back down. And I really think the true resistance zone here in this case is that $100 threshold. It's a big psychological threshold. It's just a fat number. They call it the century mark. And there's a chart pattern set up here. And when you're looking to trade breakouts, it's really, I think, important to have a good chart pattern set up. Now, some people love chart patterns and other people poo-poo chart patterns. And I've been trading for a long time. And one of the things I've learned is that the patterns do increase your probabilities. Doesn't guarantee the outcome, but it gives you a small or an express edge where, hey, I can trade with the trend. You've all heard that the trend is your friend. And there's just an opportunity to catch a breakout as the stock breaks to a new high. And the pattern I really see on this chart, it's a super ugly cup and handle. Maybe an inverted head and shoulders, depending on who's looking at it and identifying it. What I identify here is that there's a resistance zone out here at 103, and then the stock price got beat down, and then it ran back up, and it hit that same resistance zone, and it got smacked back down here, and then it set itself right back up into that resistance zone, and it's an ugly cup and handle. It looks like it's been through the dishwasher and melted. Let me zoom in on that so you can kind of see it. It's got that classic cup and handle look, which is just resistance. It comes back up into resistance, and then it sets itself back up. And if it can clear that high, boom, we love that potential breakout. Now, some traders might look at this and say, well, no, what about this over here? And I would say, well, yeah, that could be then interpreted as an inverted head and shoulders. And what an inverted head and shoulders is where you have resistance, 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 and then you have lower low and then a higher low like that. So they call this the left shoulder, this is the head, and then this is the right shoulder. And I normally think about an inverted head and shoulders as more of a bottoming pattern. And the cup and handle is more of a true breakout pattern. But tomato, half a dozen, 1/6 of the other. The point is it's going to break resistance. And if you repeat after me in your head, you'll remember this. When it breaks to a new high, it's time to buy. I'm going to repeat that. When it breaks to a new high, it's time to buy. And this kind of flies in the face of those old belief systems and concepts of buy low, sell high. This is really that buy high, sell higher. And we're taking advantage of the momentum and the general belief where, look, this is a really simple concept. Don't overthink it. The last several times this stock has approached that $100 threshold, traders and investors have asked themselves, is it worth more than $100? And it came right up to $100, and people had the opportunity to buy it above $100, but they didn't. And they also had the opportunity to sell and take profits at $100. And what happened is that resistance kicked in and prices ended up coming down. And so the answer was no. Well, it came back up into that same resistance zone and it flirted with the idea. It poked its head up there for just a brief moment, one week or so. And it then got smacked back down. And that was really helped out by the pandemic, the COVID meltdown and panic. And so that answer was also no. So the answer here was no. It's not worth more than $100. I just dropped my pen. Hold on. I'm back. Okay. Now, the next thing that happened is the prices rallied back up after getting smacked back down, and it came up to that exact same threshold, and the answer yet again was no. So it says, no, it's not worth more than $100. No, it's not worth more than $100. No, it's not worth more than $100. And that still may be true. So what we're going to do is we're going to wait to buy after it breaks out, and we're going to use a stop loss to control our risk. And then I believe the stock's got the potential to run up to 110, maybe 115, or even 120 over the next couple of weeks. Now, a swing trade by definition is around 10 trading days, ballpark, statistically speaking. And that means about 2 weeks. Now, that doesn't mean it can't run longer, and that doesn't mean you can't be an investor in this stock if you like it or if you believe it's got upside potential. But just from a pure swing trading perspective, we're going to look to buy as it breaks to that new high. Now, the general idea here is, well, if this time it can break out and prices start to rise up above that, it's going to go from a no, no, no to a yes. And if that happens, the general belief system will, hey, is it worth more than $100? And it's been saying no, but once it says yes, and the true belief system has switched over, there's a polarity of price that flips over. Well, if it says yes, it is worth more than $100, and people start buying into that, and we see a little bit of volume and participation come in, well, then clearly it can't be worth less than $100. And so what happens is that old price ceiling has a tendency to become the new price floor. So I'm going to go ahead and erase those and back it back out to the daily time frame and just look at it here. And here you can see that same general, again, kind of we're going to call it inverted head and shoulders or cup and handle pattern. And we're looking for that breakout buy above resistance. Now, a couple of things that I think are worth noting on a breakout pattern. One, you want to have a good pattern and setup that you recognize that other traders can recognize too. You also want to make sure that it's not overbought already heading into the breakout. And a real simple technique to do that is to put an RSI indicator on your chart and just make sure that it's showing RSI. You want to see the RSI greater than, we'll go RSI greater than 50, but you want to see it less than 70. And that means it's going to have some strength to it, but it's not in an overbought or overstretched technical condition prior to the breakout. And in this case, we have the RSI reading at 61. So yeah, it's above 50. And again, let me just scale that up so you can see it. It's above that midpoint 50. It's showing signs of strength, but it's not in an overbought zone. And the reason you don't want to buy when it goes into an overbought condition is just because there's a high probability of profit taking, which could drive prices back down in the short term. So you could wait for a setup like a cup and handle where, hey, it got overbought just like it did over here, where it got up to that 100, it got overbought, and then prices corrected a little bit, rode across that 200 period moving average, and it came back up, and it's set up at the same price zone ready to break out, but it's not in an overbought condition. So now we've got the general technical setup. And the real big question for me becomes, well, how big of a pop of price do I expect? And where could I place a stop loss? And then what order types do we want to use? Now, to buy above resistance, and I'd be cool personally just buying right above $100. So to buy above resistance, you want to use what's called a buy, stop, stop order. We'll learn to spell one of these. Stop. We want to put in a buy stop order, and then you want to couple that with a limit, not a market, so you can control the price to prevent a gap. And so you're going to use a buy stop limit order type. And then most traders want to use at least a stop loss. Some like to also use a target price. But if you put in a stop loss, you can put in an automatic trailing stop or a manual trailing stop. And in this case, I'd say, you know what, I could use a really tight stop, or I could use a looser stop. And usually on a real simple breakout trade, what I'll do is I'll use one of the simple measurements called an ATR. That's the average daily price range. And I'll usually multiply it by about 1.2 times, or 120% of that daily range. So I get a little 20% cushion of the average daily range. Some traders use 1.1, other traders use 1.5. An investor might use a volatility stop where they put a stop loss like 2 ATRs away. It's really kind of up to you. But I'd use about 1.2 and then use a trailing stop that says, okay, well, this average daily movement's 2.73. And so if I grab my little calculator here and we do some really tough math, I say, well, the average daily movement's $2.73, or 2.73% on a $100 stock. And I multiply that by a 120%, or 1.2, and it says, oh, well, that's about 327, and I would just round that up to 330. So I would use a trailing stop of about $3.30. Now, that's just one estimate, one method. And I could say, okay, well, I'm going to put in a buy stop limit with a first order, and I'm going to have that order trigger a second order. We're going to call that a trailing sell stop. We'll call that a trailing sell stop market. It's trailing sell stop market, MKT. And that's how we'd plan and place the trade. Now, just to show you real quick how that goes, I'm going to go ahead and just plan and place the trade here. So it's relatively simple. I can do this many, many different ways. And I'm just going to do a real simple right click on this chart in the Thinkorswim platform. And I am doing this in a virtual account, by the way, just to show you the methodology. And I'm going to go say buy custom with a stop. Now I can use an OCO bracket, which would then also give me the ability to place a target order out there at the profit target. But I'm just going to let this one run and then just trail the stop loss up. And I'm going to see if I can get my stop loss up to break even and then just let it run. And then we'll talk about profit taking techniques in another video. So there we go. I'm going to do first triggers with a stop, and that opens an order ticket with the buy order and a sell stop market. Now, I'm going to change the order types first thing. I'm going to say, okay, I'm going to do a buy stop limit. That's going to be my entry price, and I'm going to say I'll buy this if it goes above 100. And I'm going to say, but don't spend more than, I'm going to go about 10% of the ATR as a little buffer. So I'm going to say about $100.30. And that will help me prevent buying in case of a gap. And in this case with the trailing stop, it's not as critical that I do that. But if you're using a stagnant stop, what could happen, or just a static stop, like a regular stop loss, it would change your risk reward profile. So just out of habit, I use buy stop limits to control my entry price. And then I'm going to change it from a stop to a trail stop. And I'm going to set that out at that $3.30, so minus $3.30. Now, it's possible that that stop loss could get hit relatively easy. Statistically speaking, it would take more than one day movement, but that doesn't mean it can't move more than a standard daily average, or a typical daily average in this case, and hit my stop loss in one day. But in the case of a breakout, what I'm hoping is that it forces any buyers who are sitting on the sideline to want to take advantage of the breakout. They'll kind of run in and buy with us. And then anybody who's still short that stock, when it starts to break out, it's going to force them to buy to cover, and you'll start to see prices rise. And lots of traders do this where they place buy stops above resistance. And so what happens is when it breaks resistance, all of a sudden all these buy stop orders start to get hit, and prices have a tendency to pop. Doesn't guarantee that it's going to keep running up. There's a potential that the stock could completely reverse and go straight down from here. Not likely, but possible. So that's why we always want to make sure we use an appropriate position size. Now, if I use 100 shares, to make the math simple, and a $3.30 trail stop, the risk is $330. And they don't charge commissions with this platform anymore. Most platforms don't charge commissions on stock trades anymore. And it's really important that you make these stop loss orders good till canceled. And so I'm going to make them both good till canceled. So this is the instructions we're giving the computer. Buy 100 shares. Don't buy until it trades at or above $100. So it's got to go at or above $100, but don't spend more than $100.30. So that's the buy stop, and the word stop is a trigger, so it triggers into the price when it goes at or above 100. And then it's going to say, and only buy it if you can still spend less than $100.30. So that's the stop limit. And then once that order kicks in, the sell stop order will kick in, and whatever price we get filled at, the trailing stop is going to kick in $3.30 below that, which is just beyond one statistical average daily candlestick. That's a tight methodology. Some traders want to use a looser methodology, but that's really up to you and what your pain threshold is and what your trading objectives are. If I was thinking about this from a longer term position trading perspective, I'd use a looser stop loss method or do something completely different, like buy a protective put at the same time as I buy the stock, or you can learn how to use options to control and protect your risk in other ways. We'll cover that in another video. So there you have it. That is a buy stop order with an automatic trailing stop loss. And it's going to lay out the details of the trade here. You always want to read through your order tickets. And again, this is just a virtual trade, so you can practice these types of things without risking real money as you learn and you build your skill set and your confidence. So there you have it. We have a buy stop limit right above that most recent resistance point, and a trailing stop that'll kick in $3.30 below once it triggers. And now you have a really good basic idea of how to approach and swing trade a breakout trading setup. If you like this video, go ahead and click on the like button, give me some feedback, ask your questions, I'd be happy to answer them. And while you're at it, smash that subscribe button and come hang out with us over at Tackle Trading, where we're teaching people and educating people how to approach the markets intelligently and safely, and really to help you put the odds in your favor. Like and subscribe.